This is TreppWire with a special guest podcast. I'm Haley Keene with Trepp, a data modeling and analytics firm for the CMBS, commercial real estate, and CLO markets. I'm with Manus Clancy, Senior Managing Director, and Lonnie Hendry, Chief Product Officer. Today, we are joined by Carmen Spinoso, CEO and founder of Spinoso Real Estate Group. Known as an enclosed mall industry veteran, Carmen Spinoso founded Spinoso Real Estate Group in 2009. After witnessing the outflow of talent from the mall industry in the 2000s. With more than 3 decades of shopping mall experience, Carmen has led numerous real estate developments, redevelopments, and repositionings of leases and business transactions. He also remains involved in the company's leasing, organization, and operations. We are extremely excited to talk all things shopping malls with you today. Welcome, Carmen.
Thank you. It's great to be here and appreciate it.
We've been plugging this episode for several weeks now on our Week in Review episodes, so I know our listeners are excited to hear from you today as well. You've been in the real estate business, like I said, specializing in malls for quite some time now. Can you start from the beginning and tell us how you found yourself in the business in the first place?
Yeah, absolutely. Honestly, it was quite by accident. It really was not a plan. In fact, growing up, my real interest and passion was as a musician. I thought I was going to be a singer-songwriter. I played the piano and wrote a lot of music and played in a bunch of different bands and thought, maybe the next Elton John or Billy Joel was going to emerge from upstate New York. But it didn't turn out that way. Actually, I went to college and, got a degree in business and found myself right out of school. So this is in the mid 80s, selling computer systems. And I happened to have an opportunity to meet one of the children of the founder of the pyramid companies in Syracuse, New York. It was just a, purely coincidental meeting. And, we got to know each other a little bit. And this person said, you should interview for a position, at Pyramid. And I had no idea. I said, what is Pyramid? And, it was explained, they developed malls, and I didn't even understand that people owned malls. I thought it was like a public utility, like the post office. It piqued my interest. I met a handful of people at the company and through an interview process, started quite by chance as a leasing person. And, I can tell you that immediately upon joining the organization, I absolutely fell in love with real estate and with shopping malls. Pyramid was known for having these 6:30 a.m. leasing meetings 6 days a week, Monday through Saturday. We kind of viewed ourselves as the Green Beret of leasing. While everybody else was sleeping, we were, holding ourselves accountable to what we had done the day before, and we were setting out plans for the day ahead of us. As a young business, professional just out of college, I just ate it up. I fell in love with it. I also recognized very early on, because I started as a leasing person, that if you could put together the right collection of stores and dining establishments and entertainment venues and services, if you could create that right mix, then you could get people to visit your property more frequently, to drive longer to get there, to stay longer once they arrive, and to spend more. And if you could influence that, then you absolutely have the ability to impact the viability and the value of these large retail assets. And conversely, you could build the most beautiful physical plant, but if you don't have the stores and the goods and services that people want, then people will drive right by to go get, right by that building that's beautiful, to go somewhere where they can get what they want. The understanding and the focus on the importance of leasing was, ingrained, from day one, because that's kind of how I started. And over time, had the ability to develop those skills and build a vast array of relationships with pretty much every type of tenant out there over more than 30 years of doing this. And it's proved to be our company's core competency. I describe us as a small operating platform turnkey that has its DNA in leasing and tenant relationships and being able to actually execute the hard task of re-tenanting, whether it's the mall inline space or anchor stores or whatnot. That's how it got started. And it was, quite frankly, it was just a by chance conversation that turned into a career.
Well, I want to get back to the music thing at some point before this is over. I do. Maybe it'll be off the air. Maybe we can engage Carmen to write us a new jingle.
There you go.
Podcast, maybe with some vocals too. I don't know. Maybe it's time to refresh the whole thing, but we'll come back to that. Before we came on the air, we talked about how the landscape has changed for the mall space over the last 20 years, the number of players, the number of people that specialize in malls. And you talked a lot about consolidation in this space. Why don't you walk us through how the industry operated maybe 20 years ago and where you see it today?
It's very interesting. When I first came aboard, again, late 80s, the majority of the malls that existed, and let's just say plus or minus, call it 1,500 malls were built. And interestingly, most of those malls were built in about a 25-year period, from about 1965 to about 1990. There were a handful of malls that were built before that. The first mall, Victor Gruen, was in the 50s, but really the building period was like 1965 to 1990. Very few malls built after 1990. There were a handful, but not many. It's interesting. If you look back, and I've studied that period of time, the way that the capital markets work, the way that, lending for these types of properties and the kind of the development profile, it was really a good time to build properties. And there was approximately, a little over 100 individual developers that built this, call it 1,500 malls. There were a lot of entrepreneurial, they were all privately held, basically, entrepreneurial real estate developers that had varying degrees of ability, but they were all very focused because they were their portfolios. And as it was, many of them had kind of a regional focus. So like, for example, Pyramid, where I began my career in the late 80s, was focused primarily in New York State and in Massachusetts. And that was the case for the many different developers. And again, these were, predominantly family-run businesses. Many of them came out of construction and then got into the mall development business. And at the time, in the way that the capital markets and tax laws work, it was incredibly lucrative, or could be incredibly lucrative. And generational wealth was created for these firms. And whether it was the Simons or the DeBartolos or the Taubmans or the Conjals or the Wilmots or the Cafaros, these companies were very entrepreneurial. And as I mentioned, many of them were pretty much, family businesses. And that was the case throughout that building period, 65 to 1990. And the transformation began really around that 1990 mark, 1989, 90, and 91, as our country kind of entered into a very strained economic period with the savings and loan crisis, record high interest rates, the Gulf War, and not too dissimilar from the most recent GFC in 2007, 8, 9. Capital markets were really shut down. And these developers that had a lot going on in a very capital intensive industry suddenly lacked access to capital. I mean, there were no loans to be had. And it was a very strained period for these family businesses and these entrepreneurial privately held companies to not be able to access capital and refinance their properties and so on, which is the reason why, if you look at the dates that these companies went public and transformed from private enterprises into public REITs, or real estate investment trusts, the first was Taubman in 1992, followed in 1993 by, Simon and General Growth and many others. So the economic struggles and the impact of that on the capital markets that happened in 89, 90, and 91 led to the need to go public that started in 92, 93, 94. And when that happened, by the way, it was predominantly a method of survival. It wasn't like the original business plan for these companies. And after going public, the business model changed dramatically. When you're a privately held company, you can effectively do whatever you want to do within reason, obviously. When you're public, it's a different environment. I mean, there are analysts and all types of considerations that drive decisions that are not the same when you're privately held and you own these assets independently. When you're a public operator, you're beholden to the analysts and the things that drive stock price, and that may sometimes be divergent with what you believe is the right thing for the real estate long term. I saw the industry started to transform pretty dramatically. And from the early 90s and through the latter 90s, there was a massive consolidation such that, call it the 100 or so original developers, were effectively consolidated down to a handful, less than 10 big public companies that owned or controlled the majority of the malls in the country. And with that massive consolidation came a massive outflow of human resource in the industry, because if you buy all these companies, you don't keep all the employees. You're consolidating for efficiency and so on. It was kind of a number of these factors that I could see this dramatic change happening. And there are a lot of other nuanced things that are a result of that. one of them is, by the way, the capital market side. When I first came in, most of the loans on these properties were, balance sheet loans with pension funds or life companies, kind of long-term lenders. And that changed over time with the advent of the CMBS market, and then kind of, more of these properties being, in conduit deals and then ultimately SASBs. It changed. The relationship between the borrower and the lender were very different. And it became obvious to me as time progressed that there would ultimately be a transference of ownership, that the big portfolios that were aggregated by these public companies through this consolidation would ultimately be pruned. And, if there's going to be a transference of ownership, who out there has the platform and the skill and the understanding to, maximize these very complicated, nuanced assets? Because malls are very different from other forms of real estate. And that realization led me to write a business plan to build, what I consider to be, the most unique privately held operator out there. We're different. We don't have very many competitors, but, we are true mall DNA and leasing, oriented operator. And I think that's a little bit of a different take on, most of the other people that are in the space. That consolidation, happened over time. And ultimately you're seeing now, kind of this transference of ownership and kind of I think a return of, private operators to the space in a way that's very meaningful. So I hope that answered the question.
So before we came on, we were talking about, your business operations. I think you said to me, 50% of your business is leasing and operating malls on a going basis, and 50% is the receivership business, loans that have needed the help of a receiver to come in and stabilize things. Can you walk us a little bit through each side of the business?
Yeah. So on the receivership side, we do a lot of work there, and we have done a lot. In fact, when I started the company was in, as you mentioned earlier, 2009. So if you just kind of roll back the clocks, to that time, I mean, we're in the middle of the GFC, right? There was a lot of CMBS 1.0 maturity defaults that were malls. And we started working with the special servicers that were handling those defaulted loans and taking over those properties. So we kind of cut our teeth on that. And in the process, began to really understand at a pretty sophisticated level what these special servicers were dealing with, and master servicer impacts, and some of the regulations and issues that need to be followed, like REMIC concerns and, a lot of other factors. So we really began to develop that and build relationships and understand, the need for these assets and how you can actually affect change. In fact, if you think about it, 2009, 10, as we're starting and we're just bringing on our first projects, it was an interesting period. I mean, the nation's economy was struggling, and were you really going to be able to get tenants to sign leases, long-term leases, and make investments into properties that are in receivership or taken back REO? Fortunately, we were able to prove that was in fact doable, and we did it, quite well. That's a big part of business. And the other thing that happened is coming out of that. So we're in the early years of our existence. During that period, by the way, 2008 and 9, as I'm sure your listeners will remember, probably not fondly, but will certainly remember, there was a similar situation to that 1990 period of time where capital markets were shut down and there wasn't a lot of lending happening. There was no CMBS securitizations. But as we came out of that, and things started to strengthen, macroeconomically throughout the country, and the capital markets opened back up, we started to see all these new securitizations happen. So if you look at 2011, 12, 13, 14, 15, coming out of the GFC, there were many new issuances that had hundreds of malls in them. And as we worked with these special servicers and in this space, we really started to study these securitizations and the assets that were in these conduits, looking at them and staying on top of them. And we have a pretty intense business intelligence team that, helps us stay up on all of this. And we've got some pretty incredible data that we've accumulated over our lifetime. But as we watched that and things that were happening, proceeding from then to now, we could see that at the 10-year maturities of these securitizations, these new securitizations, so 20, 21, 22, 23, 24, 25, and so on, there was going to be, a massive amount of maturities that we're likely not going to resolve, with a payoff. That's certainly true. And I think everybody's pretty, aware of that. We've kind of been monitoring that. Really, nobody could predict, but when the pandemic hit, a lot of that dislocation was pulled forward. We took over more properties. I think I'm currently the receiver on 15 or 16 malls. We're watching that, and we've got a kind of a prediction on every single one of these assets. And not just, those that are in CMBS. I mean, there's a lot of non-CMBS deals that are going to face these same issues at maturity. So it's an interesting time, but that's a big part of what we do. And the other, I would say, half of our business are properties that are owned by investors, whether it's private equity firms or hedge funds that engage us to maximize them, through leasing and redevelopment and densification and expansions. And then others that we are in a joint venture relationship with, other parties to acquire for our own portfolio. And the most recent announcement that we made was about a month and a half ago. We closed on Solano Town Center, which is a 1 million+ square foot, 2-story super regional mall in Fairfield, California, where there's a lot of opportunity to do all of those things that I just mentioned, new anchors, densification, new non-retail uses, leasing and marketing. We're actively looking to expand that, our ownership position in these properties. And we're in the process of working on another deal that I think we'll be able to announce hopefully by the end of the year that we close, and many others that we're working on. So those are really kind of the two sides, Manus.
Well, I want to give Lonnie the conch in a minute, but I wanted to ask one more related question on this topic. You said you had 15 or 16 malls under receivership. We usually know how this goes. A REIT will come out and say, this property is non-core. We're not going to support this anymore. Eventually they default on the loan. A receiver is brought in, and this could take a short period of time or a long period of time. How often does it take place where you come in as a receiver and think to yourself, if I had been brought into this asset 2 years ago, they wouldn't be making this non-core. They would not have given back this asset. Is that something that you think, some of these owners could have taken more proactive measures earlier on, and some things that resulted with losses or transfer of ownership was avoidable?
Yeah, so that's a really interesting question. There's a couple of ways to think about that. One is that if a loan or a mall asset that the loan is, the current borrower is a big REIT. I think what we've seen in the past, so a handful of years ago, would be a very logical thought process. Like, look, these big REITs are very powerful, organizations, so we'll extend with them for a period of time. It makes sense, or at least at the surface it does. But I think the reality in many situations, and there's no broad brush that is every circumstance. But what I have absolutely seen, to your point, is the failure to replace that borrower, because a disinterested borrower, that isn't like the day that the loan matures, right? They know, if the maturity is in 24, by 21 or 22, they have an opinion on if this is something that they're going to keep or not. And if it's not, and that happens often, it can be for a number of reasons. But if it's not, that period of time between that kind of thought process and the ultimate maturity is generally characterized by, a lack of focus, right? A lack of energy, a lack of, everybody in today's environment feels the constraint of limited resource, right? I mean, everybody. If you look at, many of the big REITs, had significant layoffs during the pandemic, and they've not, fully rehired all those people. So there's certain limitations, right? And if 2 years from now, I'm not going to care about owning this asset, it's not going to get the focus and the attention. And the problem with that is, I use the analogy of a kind of a basket of fruit. Malls are in certain respects very, very similar to that. If you don't take care of that basket and the apple gets rotten, the banana turns brown, it can go bad, and it can go bad quickly. And then nobody's going to want to eat from that basket. However, if by replacing the borrower that's disinterested with an operator that's, focused on this property and truly has putting forth effort on it, and it's like taking that rotten apple and putting a nice shiny red one in there and a beautiful new banana and sprinkling some berries, people will come back and they'll eat from that basket. And that's what's necessary. I was on a call not too long ago, and I was talking with somebody who is a big investor in the bond space and some of these CMBS deals. And he said, yeah, these disinterested borrowers that, have these maturity defaults or are going to have them, or have been extended, which is even worse. Sometimes they're like zombie borrowers. You're right. They don't love the asset anymore. They're just trying to suck the life out of it, if you will. I thought it was kind of a funny analogy, but it's kind of the case, So to your question, I think that that's something that can be very, very detrimental. It's like letting that basket go, be rotten, when instead of just simply tending to it, it could be better. We've taken over properties where you see that. We'll take over a property and we're talking to the general manager and they're like, yeah, we haven't seen a leasing person in 4 years. We haven't had a new deal in 5 years. Like there's just no reason for that. But again, it's really pretty, it's pretty understandable. If you're not going to keep this property, you're not going to, put more investment of time and resources, especially when it's limited, into those things that you really don't care about.
I suppose there's nothing that can be done about that, right? If you're the lender and the mortgage payment is being made, the disinterest may be there, but until you reach that balloon date, you would love for the CMBS industry to have some kind of vehicle to identify and coax along a disinterested buyer to maybe make a decision faster, but I guess that's impossible.
Yeah, it really would come down to parts of the pooling and servicing agreement that might give you the opportunity, if certain, tests like debt service coverage ratios or whatnot are not being met, and perhaps in those scenarios you could do that. But you're right. At the end of the day, it would be great if you could do that. But if you don't have the, the technical ability, you're just really waiting for that maturity date. I think the important point there, though, is to not extend. And that's easy to do. It's easy to justify, like, I'm going to leave this with, this major national, real estate investment trust. That's where it becomes, I think people are realizing that that's not a good solution.
Yeah. So Carmen, we've covered a lot of ground so far and very exciting stuff. And I know we hadn't, talked offline about some of the questions, and we were going to talk a little bit about the leasing later on, but I think it really parlays itself nicely given the receivership angle and the disinterested borrower. I know in some of the servicer commentary notes that we track, you guys have been mentioned repeatedly as taking over these deals in receivership, and then immediately it talks about how many new leases have been signed and how your impact is felt almost immediately. So maybe, with your background in leasing, give us some perspective on how that's effectively the lifeblood of the mall and how you guys approach that maybe in a unique way to drive the results that investors are looking for.
We have been very successful in doing two things. One is stabilizing an asset, right? Because generally speaking, and we do a lot of analytics when we take over a property. What you will have seen in the preceding several years is oftentimes a steep decline in NOI heading into maturity. And that's for the reasons that we kind of already talked about. It's really critical to be able to stop that decline, like to put the brakes on it. And that's not easy to do, but it's absolutely critical to do so. The second thing is to, be able to attract new tenants and sign new leases and improve occupancy, improve the quality of the tenant mix, drive more traffic and sales and improve NOI. So that is a really critical piece. And, we do have a very, I think, unique approach. We have leasing meetings every day. I actually attend all of them. And, with 30 plus years of experience, which it's hard to believe that I'm actually saying that, there's very valuable insights and strategies that not just me, but other members of our senior team. We recently brought aboard a new EVP of leasing. His name is Mike Nevins. He was formerly the COO of Simon. He was the EVP of leasing for Simon as well as Macerich, previously. And I've known Mike. I hired Mike when I was at Wilmerite 30 years ago or 31 years ago. Hard to believe. So we've known each other for a really long time. And we've got a very strong team and a very strong leasing engine. We have meetings every day. Our leasing people are highly trained, highly managed. They get a tremendous amount of support. Our systems and the different, tools that we use in leasing, I know nobody else does it like that. I know that because our senior team have been with these other groups, and there's a very, very big difference. And I think one point I'll share with you. So during the pandemic, I remember February, March of 2020, I'm sitting in my office and we're closing our office building. Everybody's going to be working from home. We're shutting all these malls. It was everything, like future was unknown, right? Had no idea what to do. And we saw many of the people that we do business with laying off their employees, and there was nothing to do, right? I mean, there were no new stores being done. I remember talking to, groups that are tenants, like large national tenants, where 95% of their real estate department was furloughed. The same was true, by the way, of many of the REITs. I'm thinking like, what do we do with all of our leasing people? There's nobody on the other side to even talk to. So what do we do? Do we do the same thing? It's a family business, right? I mean, and we're not a public company. And, I thought, gosh, that last thing that I would want is to be, furloughed and my pay cut. And so like, we've got to find a way to keep everybody going. But what are we going to do with the leasing people that literally don't have anybody to talk to? We said, okay, we don't know how long this is going to last, but what if we have a leasing meeting every day for 8 hours every single day? And we do a couple things. Number one, we do training. Number two, we do planning and rethink the merchandising mix of our properties and whatnot. And number three, and this is one that I found really cool, was we would write the most thorough, comprehensive, sophisticated manual on how to do this that we could use as a training platform as we bring on new people, because we're constantly hiring. It's kind of like the line from, I think it was Boiler Room, like, we don't hire brokers, we train new ones. So we have a big feeder program with interns and with real estate degree graduates where we bring them in and we train them up from ground zero. It was incredible, the level of engagement we had. I mean, we had Zoom calls every day that would literally go 8 hours, and we would come up with every topic, like, how do you negotiate co-tenancy in this circumstance? Or how do you negotiate for a better break point? How do you get a below natural break point? What is the method? What are the business arguments you can use? And we assign different topics to different people, and we would, just like vet these issues on calls. We would take notes, and then ultimately it got processed into a pretty comprehensive and very, very unique leasing manual. Now, that's kind of our DNA, right? I mean, we think about it all the time. We have meetings, we vet things, we challenge. And, I've heard a lot of retailers over the years say, we hate dealing with you because you guys are really tough and you negotiate. You don't just like agree to what we ask, but we really appreciate that you care and that you're actually doing something good for the mall. That's kind of, I've said that we could give our manual to somebody, some other group, and they wouldn't operate that. It's just like, just because you have the words on a piece of paper doesn't mean you can actually do it. What it takes to operate at that level is a level of commitment and management and daily insight and, and energy, and a book isn't going to give you that. But we have it, and we use it as a training platform for all the people that we bring on, even the ones with experience.
I don't know about you, Lonnie, but I would pay to watch these videos. I got to say,
Yeah.
I think that there would be a big audience out there if you package these and put them on the internet. I think it's a real estate master's program waiting to happen.
It is,
from the sounds of it.
I 100% agree. Maybe one of these days we can spend 30 minutes on a Zoom call, and I'll show you some segments of it, and I think you'd find it really, really cool. And we have these.
Lonnie and I are just complete junkies for the subject matter, and I think we would eat that up. So I want to tell our audience how this all came about. As our audience knows, we're constantly reading special servicer and servicer watch list notes every month as they come out. More and more, we were seeing the Spinoso Group listed as the receiver, often with very, very positive remarks. I want to talk about one asset in particular. This is the Glenbrook Square, backs $150 million CMBS loan. It's in Fort Wayne, Indiana. So not exactly what you call a growth market. The loan had been delinquent for more than 2 years over the last couple of years. DSCR fell from over 2x to just over 1x over the course of a couple of years. Here's what the special servicer had to say, and this is what got our attention. The receiver has engaged Spinoso to manage and lease the property. That has resulted in renewing a significant number of tenants, approximately 30, with an improvement of rents in most cases, and a number of new tenants that are now engaged to take space at the property. That's not the kind of thing you hear for Rust Belt malls that have been around for a long time, right? That sounded like it was a recipe for a disinterested owner, and this was a loss waiting to happen. Tell us what happened there and why you were able to kind of completely reverse course on that asset.
It's funny, Manus. I didn't know you were going to bring that up. I actually was at Glenbrook Square Mall last Monday, a week ago today. So I was out in Fort Wayne. I actually went out a day early and spent time driving the competition, just looking at the market overall. We do that routinely with all of our properties. There's no substitute for actually, getting out in the field. So I happened to walk through the mall, and, what you said is absolutely right. I think this is an asset. It was a maturity default, right? It was owned by a REIT. There was a prior borrower that was a REIT, and for many reasons, very many good reasons, I'm sure, from the perspective of the REIT, this was not one they were going to keep. So, it falls into that cycle, right? I mean, you're not going to invest a lot of time or energy into something that you're getting rid of. And I'd say that's the case here. When we took over the mall, I think there was 37 tenants that were either expired or had a very near-term expiring lease that needed to be dealt with, which was a larger percentage than I've seen in most cases. So that I think there was like 47% of the mall was like basically expired. So it required, some pretty aggressive triage. Now, I would say one thing about Fort Wayne is actually it is growing, which most people don't realize. It has the reputation of kind of being, a Rust Belt city. And while it may not be massive growth, there is definitely, and I think the pandemic kind of spurred this, some of the major surrounding cities, there's been an outflow into Fort Wayne. So, we've done a lot of research on the property. First of all, it's the only real mall, right, in that area. There is some competition, but it's not particularly strong. The mall is not too big for the market, and there's a lot of really strong performing tenants in there. We start to build a business case for why this is a very viable project and start to generate new interest from new tenants. And we've done a bunch of new deals. We've only been on the mall for maybe a year. We went out, and I think of the 37 expiring tenants, I want to say like 30 of them, we not only renewed, but we renewed with term, and we renewed in an increase to their originally contracted rent, which you don't see very often. But we were able to, convince retailers that, like, look, this is a very viable property. We are on it. We're going to make a huge difference here. There's a vacant Carson's department store there that we've got really strong interest in for some very creative, very cool new tenants. Hopefully we'll be announcing soon. And, we were able to just, be very diligent in the negotiations. And, it always starts with, hey, we'll do a short 1-year deal at a reduction to rent. And these tenants expect that, you're just going to roll over and agree. We negotiate hard, and we do it from the spirit of having a really good relationship with them and making deals that make sense. But but everybody needs to understand that if every tenant rolled their rent down, there's not going to be an opportunity to really make a long-term lasting impact on this property. And ultimately that's what they need to have happen. So the execution has been really good. We've done a number of new deals. There's a strong pipeline of leasing activity there, and it's just really going out and doing what we say we're going to do. We also have a good mall team there. The general manager is very strong. We've been empowering them. Oftentimes if a property is going to go back, the prior borrower isn't investing time or energy, and which means that these things oftentimes become almost like an island unto themselves. And the people that work there, generally what we've found, are very passionate, and they really care about their property, and they have a real sense of ownership, but they just are disconnected, and they feel that lack of love and affection for the property. It's debilitating. So when we come in, we involve them in our leasing meetings. We go down and we meet with them. We spend time, we integrate them into our process. We just had we do this periodically. We had a GM summit where all the general managers from all of our properties across the country, which is, I think we've got about 45 malls now, come together. And there's a sharing of information. There's, a strengthening of the bond between all of our properties. There's a really good team there. And when they get plugged in, that's a part of the equation to help make these things better. So it's really all those things.
Yeah, so this one's kind of just a macro. You talked a little bit about some of the upcoming maturities and the challenges with servicers either deciding to extend or, take other action. And that has some negative connotation. But from your perspective and based on your track record, what are the things that you're most optimistic about in this sector going forward?
One thing is the demand for brick and mortar space and new stores has me very optimistic. If the pandemic proved anything, it is the durability of brick and mortar, right? I mean, the narrative has been forever. The internet, everybody's going to do e-commerce and drones are going to fly products to your house and you don't need stores anymore, and closed every mall in the country. Our industry did. If that narrative was really the truth, then when people could only shop on e-commerce, which is what happened, they would have just kept doing it. But that's not how it played out, right? I mean, we opened the malls and people came back, and they came back in many instances in higher numbers, spending more than even pre-pandemic. And while there certainly was a, pent-up demand kind of impact there, it's been sustained. And the thing that really came out of it was, I think, a refocus for retailers on the importance of brick and mortar, because many retailers whose internet sales or e-commerce sales went way up because that was the only channel that was open, recognized that their profits went way down. In fact, there were retailers that actually closed their website during the pandemic because of the negative impact on profitability. In fact, TJX just announced that they're shutting their website for their home goods division. Their focus is going to be strictly on brick and mortar. So one thing that I'm very optimistic about is kind of the refocus there. And another kind of offshoot of that, Lonnie, is especially with, supply chain issues and rising costs and interest rates being what they are, there is very little retail GLA being constructed, right? So if there's increased demand and little supply, that puts properties in a good position. Even B or C or D malls are often in A locations in their markets. They were built at a time with, the main intersection of the most big traffic thoroughfares with incredible visibility. And there are a lot of people that are, very willing to lease space in malls because they recognize the quality of the location and the viability of the concept. I think the pandemic has been a huge positive for people's understanding of brick and mortar and, the value of it. It's, these assets are irreplaceable in many cases, and certainly gives me, cause for optimism.
We know now that brick and mortar is not going anywhere. And you've talked about your mindset in the beginning of COVID. Give us a little bit into what your mindset was in 16, 17, 18, when you saw these iconic brands like Toys R Us and Sports Authority, not go chapter 11, but go chapter 7. And what was, going through your head at that point? Did you think that maybe brick and mortar was going away? It certainly seemed like those were the darkest days.
Very interesting. I mean, I have had many conversations on this topic. No, I never did. And here's the reason. When I started in the late 80s, most of the tenants that we were doing deals with, so you can think of names like US Shoe and Melville and Merry-Go-Round. I mean, most of those tenants that I was doing deals with were already gone way in advance of that. What I ended up realizing pretty early in my career is that the retail life cycle is constant, right? I mean, there are stores that are, emerging concepts. They go through a growth and popularity phase. They kind of mature. Then there's usually a decline, and then they're gone. And this is interesting. If you go back and look at the 20s, 30s, 40s, 50s, very, very few, with the exception of a handful of luxury brands, very few retailers have made the transition of decades like that. So it's actually always been the case. And I remember when I first started, there was Woolworth, right? There was, many, there was Ames and Caldor, and like those guys, that just always happens. The difference is that there has been much more of a focus and news headlines on these things that, when Toys R Us or Radio Shack or some of these other brands went out of business, it became such a headline and was looked at as like a leading indicator for an industry that has always had that happen. It really was nothing new and nothing more severe than ever. So no, I always just thought it was kind of funny that people were thinking that this is spelling the doom and gloom of brick and mortar, when I'm like, guys, this has been happening ever since before I started. Like, it's no different. And there's always new concepts. In fact, I would make this bold statement, and I'll make it here first publicly. There are more than enough stores to fill every vacant space in every mall. There are more than enough tenants. It's just a matter of going out and finding them. 100% believe that to be true. And we find a lot of them. I mean, we're doing deals with many emerging concepts and startup businesses and mom and pop restaurants, and whether it's pickleball, which seems to be a very popular thing these days, but there's always new stuff. And it's just a matter of the hard work of getting out there and rolling up your sleeves and getting in the trenches and finding it and making deals. And that's something most people don't want to do, but we do it.
Yeah, so it's really interesting. You mentioned pickleball and a couple of the other things, and I've read, anecdotally that these large retailers are really going towards more experiential type of retail. I wanted to get your thoughts on that. I mean, does pickleball check the box there? Is there something else? And then just as a follow-up, for the last several years, it's like if Apple is in your location, the store sales per square foot across the mall seem to be significantly better. Have you guys experienced that, or is there some other type of tenant that maybe used to be a big box that would draw people to the mall that now it's an Apple or it's something like that, maybe outside of the experiential retail, but something that's a magnet for people coming to your centers?
Well, Apple has certainly been one, right? I mean, they just do an incredible job in every way. And, it's certainly kind of like an indicator, right? If you have Apple in your property, it kind of sets the bar. And there are a lot of retailers that, kind of see that as an indicator and are followers to Apple and the locations that they're selecting. There's quite a few others. I mean, I think Lululemon is a great, addition, and they draw an excellent shopper, and other variations of that, like an Athleta or Fabletics, I think are also really good. But the issue of experiential is a really interesting one. And, those retailers or other users that are, investing in improving their operations and incorporating more of an experiential type of a component, I think that they're the ones that you want to be doing business with. One that comes to mind, and it's a really interesting story. We're actually doing a number of deals with them right now, is Dick's with their new House of Sports concept. So while the industry narrative has been, we're downsizing our stores, we're getting smaller, whatever, they're expanding. And they're incorporating these different experiential components, whether it's simulators and they're improving the depth of their product offering. And their stores are incredible. They've added this outdoor field component, and just the overall experience in going to one of these House of Sports locations. And, they've been public that they want to open, 100 of these new stores in the next handful of years. So, I mean, it's kind of absolutely counter to what the narrative has been. They are showing and demonstrating and leading, actually, the value of investing in your stores and incorporating, experiential components, which can be done numerous different ways. I've recently gone to a couple Macy's stores that have remodeled and was, super impressed. So I think the experiential focus for whether it's retail, inline stores or anchor stores or restaurants is an important piece. And it's something that we are focused on. I mean, does pickleball check the box? I think that was another question. I think it's a really cool use. I know a lot of people who play, and they play pretty frequently. So it has more of a grocery type frequency of visit. So you're drawing people, sometimes multiple times a week. Versus traditional retail, it's a lot less. There's a lot of synergistic benefit. I mean, people are going to come to the mall. We're doing a deal right now in a property that has a 40,000 square foot vacant former retail space. And we actually are putting in a pickleball operator that has multiple units. They're really high quality. They build beautiful facilities, and they don't have a food component, but they draw a significant amount of traffic, which should translate into improved sales in the food court or the sit down restaurants or other food offerings that are in the property. So there's a lot of that. And I like the use. I mean, it's good, clean fun. It draws families and brings repeat traffic. I like it. It's fun.
Yeah, that's really great to hear. I was going to ask one more question. What is one of the most difficult things about operating a mall from your perspective? And before you answer that, I just want to state for our listeners, it's really great to have a CEO of a company on that knows deal specific type of anecdotes. So Carmen's just, freewheeling on these things, and he knows about 40,000 square foot deals that they're working on in multiple locations. It's not every day that you're talking to somebody that's at his level that also is in the weeds as much as you can tell he is based on the commentary. So I think that's something I don't want the listeners to miss. It's really great to hear and see and feel from our perspective today, like you really are in the weeds with these leases and everything else. So that's really great. Back to the question. What's the most difficult thing of operating a mall? And then, so you can give some kudos to Spinoso. how do you guys, do that better than everyone else in the space?
It's a very complicated, nuanced asset class, right? So there's a lot of circumstances that you have to navigate when you want to do things. I mean, REAs would come to the forefront as one of the biggest challenges. You may have a great plan that requires the approval of other members of the REA, which is a reciprocal easement agreement. So typically those are your anchors. And sometimes you will have, an anchor that's owned by somebody that is, not operating, and that could be very difficult to be able to get their cooperation. And so I think REA negotiations can be a huge challenge. Fortunately, with regard to how we approach it, we have decades. I've worked with every major anchor tenant for, my entire career. So whether it's the good people at Macy's or JCPenney or whatever, Dillard's, one of my favorite to work with, Belk as well. We have a good working relationship, and they know that we are thinking holistically to benefit everybody. So the level of reception for ideas and approvals that we seek has been really good. And they know if we're calling them up, then this is something that is likely to be really important for them and will add value to either their retail operations, the value of the real estate that they own, or both. I think that's probably one of them, Lonnie. I think the other most challenging thing is leasing, right? I mean, finding people that are willing to come in and occupy spaces in an enclosed shopping mall and sign long-term leases and build nice stores and make a commitment. It's not easy. It's hard. It's not sexy. You gotta, like I said, you gotta roll up your sleeves, get in the trenches, and it's sometimes it's like hand-to-hand combat. But we've got a really energized, highly trained and well-managed team, and we're successful in doing it. Those are probably the two things that would rise to the top.
Well, I'll close my remarks with one last question. When Carmen Spinoso is walking through a mall, is he picking up things here and there? Is he picking up something from Macy's and something from JCPenney, helping your own cause? Are you eating at the food court? Are you walking out of there like the dad in a big Hallmark Christmas movie with bags and bags of stuff? Is that part of the MO?
I'm sure my kids would love that, but no, I do eat at the malls. That I do. And if there's something I need, I would. But what we do is we do walk through these stores and we look at them, look at the merchandise levels, look at the, we talk to the employees, we ask them what they're seeing and hearing, the sales associates and the different retailers. So no, I don't have like a loaded car. Usually I got to get back on a plane. I wouldn't have room anyway. So.
Well, thank you, Carmen. This has been a treat of an episode. I think we have more to cover for maybe another time because we never got back to you being a musician or potentially recording us a new